Scott, we got Steven on the line. What do you want to ask him?
As a single family investor, all my properties are kind of within an hour's drive for me. And so, how did you make that transition? I understand there can be greener pastures in other states, but how did you make that jump into being in so many places at once, building so many teams, finding so many deals and things like that there?
Well, I would say from day one, I was pretty dead set on creating a business that would be location independent at the detriment of potential profit, even while focused on single family. I lived in California, then in Denver, and operated a house flipping operation in the triangle of Raleigh and in Minneapolis. And so there's a big downside to that. You don't have that same local network effect. You're not there. You can't just easily drive over. So you have to rely on other people. As a benefit of having to learn how to rely and hire other people, I was able to put different processes and people in place to be able to check and verify that things are happening as planned. When expanding into the commercial real estate space, it was actually a big driver, was the fact that these individual projects are large enough to be able to absorb the cost of travel for me or other team members to go out to those individual assets, visually inspect them, walk them, do all the things that we need to do.
I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. Welcome to another episode of the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, and I'm very excited for today's show. It's another one of our Ask the Expert episodes with two amazing people on the line with us. We got Steven Pesavento from Von Finch Capital, and we got Scott MacDonald. Welcome to the show, gentlemen, and I'm ready for a lot of fun. How about you guys?
Yeah, let's go.
All right.
Forward to it.
Steven, you're up first. Let's talk about you a little bit. Tell us a little bit about yourself. Tell us about your background and how you got into this multifamily investing thing.
When I was a kid, I wanted to be one of two things growing up. I either wanted to be a chef like Emeril Lagasse, or I wanted to renovate houses like Bob Vila. And after nearly a decade of working in the food industry, I realized I'd rather own the restaurant than work in it. I suppose you could say all that HGTV eventually paid off. But I started my career as a management consultant, graduated from a great university up in Minnesota called St. John's. And I dove into the corporate world and I started living that corporate life. It was, prestigious title and great income, but there was a huge lack of passion. And I noticed that a lot of people that I would meet, a lot of the FTEs and full-time folks, they were really living for that 9 to 5. They were really living for that moment that they gotta get off work and spend that time with their family. And believe me, I want to spend time with my family, but I really believe that you spend majority of your time working and you better be passionate about it. So I went on this journey of moving first into high growth tech startups and then eventually into real estate, because there was a lot of people who were very passionate, a lot of dreamers, a lot of believers, and a lot of people who were doing it. And that's what really drew me in, was not only the ability to make great income, but also the ability to really focus on personal and professional growth and be surrounded in some great communities of people who think like me, who they want more freedom, flexibility, and fun in their life. And they want to be able to create that. And they believe it's possible. That's really how I kind of made my way into real estate. And, I first started when I got into real estate way back in 2014. I was renting an apartment on Airbnb. I was traveling to see a gal that I had met who lived out of state, and I was making money by going and seeing her. So I was like, this is a pretty great thing. I ended up getting 2 more of those. I was running Airbnb arbitrage. And then I never really thought of that as real estate. I just thought of that as another hustle, right? I mean, I was making a lot of money doing it. But when I really came full time into real estate was back in end of 2015. And I went full bore into single family. I had found a really great mentor at a local meetup who I convinced to teach me everything she knew. And that first year we bought 75 properties and we went on to buy over 200 properties in 2.5 years before eventually, really expanded into the multifamily space and started building a private equity company and then in a sponsorship and operations organization. And that's really where we're at today with Von Finch Capital.
All right. All right. I love it. Lot of goodness there to unpack. Something I appreciate you saying is it is the reality that most people spend most of their time working. 40 hours a week plus commute for a lot of people ends up being a lot of time spent on the job. It needs to be something that you're passionate about, or it's a lot better if it's something you're passionate about. Getting into real estate, you said you started single family first, and it seems like you were able to scale pretty quickly. You said, if I caught it right, 75 purchases in the first year.
I
All
had
right.
never owned a single piece of real estate before I went full time into real estate.
Yeah.
And that first year, yeah, we bought and exited, 75 properties. We're focused on flipping properties primarily and going direct to seller. The way that I got into that business was I had this moment of clarity. And for years I had wanted to buy real estate. I had saw the value in it. And I really believed that it was something that was going to be a tool that would allow me to live the life I wanted to live. And most importantly, allow me to not live the life that I lived growing up. I have a couple great loving parents, but they fought all the time about money, got divorced young, moved every couple of years. And money was just one of those big pain points. And I'm sure a lot of folks who are listening can relate, but there was a point I remember making that decision, walking in, seeing my dad crying, and it was, after another fight, more money issues. And I just decided then I'm not going to ever live like this. Yeah. And so I kind of went out, and my whole life I had been hustling to make things happen. And then when I really started in real estate, everything just clicked. We really were focused on going direct to seller, buying houses directly from homeowners. And I focused on, my ability to build a really great team and to market and be able to pull in those kind of prospective clients who were interested in selling. And there was a lot of great things about that business. It was fun. It was exciting to be able to change these properties and see how you could walk into something that was really a junker, an ugly property, and turn it into something that was going to be a great place for families to live. But there was a lot that was missing as well. And I only learned that after running that business for a few years.
Yeah. I love it. Now, I tried my hand at single family, and the idea of scaling, single family portfolio to me seemed a little daunting, which is why I got into multifamily. But like one of the things that you highlighted, or the things that you highlighted to be able to scale in single family, was your ability to find a good team, or to create a good team, and your ability to market. And I think those are two important concepts no matter what you're doing. Let's talk a little bit about the transition from single family to multifamily. What prompted that transition, and what were the challenges that you had getting in?
So I'm running this business. We're having fun. Mind you, all of this is remote. I first lived in California, then in Denver, while running two different house flipping organizations, one in Minneapolis and one in Raleigh, North Carolina, in the Triad area. So the triangle and the Triad. And we're running this business and it's great, but there's something that's missing. And I'm seeing some of that lack of scalability. I'm putting a lot of trust on an individual basis into team members that don't have aligned interests. I can't physically go and look at every property. It doesn't make sense because I'm in another state, 1,600 miles away. I started really analyzing and trying to understand what I really liked about the business and what was missing. I was sitting at a conference, and this business professional was going over this idea of your ideal client. And I'm sitting down and I'm looking at that, and I'm thinking to myself, like, who is the kind of clientele that I want to work with for the next decade? And what does that business look like? And my current business in single family was very transaction based. It was one-time transactions, and there was nearly never an opportunity for repeat business, because it's rare that somebody sells their house for 60 or 70 cents on the dollar twice. And so we're dealing with people who maybe they don't have the investor mindset. They're not thinking about growth. And in some ways, they're really in survival mode. And they're not open or interested to thinking on this higher level dynamic mindset type of plane that I really live on, and that I'm working on. And so I sat down and I started architecting, what would that look like? What would that business look like? How would we work? Who are the people that I currently work with that I'd love to keep working? And I looked at, how could I change this business to really fit that model? And it was probably about 6 months to a year of working on making some changes in the business before realizing that that wasn't going to happen. And I had been running both businesses side by side as I was going out and, building my investor database, looking at properties on the commercial side. And we had a tragedy happen in our family. And when that tragedy happened, I lost somebody who was really close to me, my younger sister. And what it made me realize was it knocked me all the way down. I was the mindset guy. I was able to do anything. And I realized that all that work I had done, I wasn't as strong as I thought. You think these things never happen to you, they only happen to other people. But what I realized in that moment was that it was my duty to change the direction that I was going, that I couldn't live another day, focus on a business that wasn't going to serve. And most importantly, it was a disservice to be focused on a business that relied on me as much as it did. It really created this motivation to go out and start creating that passive income for my clients so that they could really have that freedom and flexibility. And for myself to know that if something bad happens, as it can any day, you can walk out your door and you may never come back. Or you may have something that you didn't want to happen, or, you could deal with a COVID type incident where everything is thrown off and you just can't plan for that. But what you can plan for is to really be able to kind of put those key foundation pieces to make sure that you and your family are protected. And so it was directly after that I made a pretty strong and swift decision, cut off all marketing in the single family business, what I call drain the swamp. We worked all the leads for another 6 to 12 months while we was continuing to build the new business and transition all of our investors over to long-term cash flow focused type holds. And it was in that moment that there was like a new light that was really developed. It was this excitement factor of knowing that I'm working with other people who are just like me, people who are successful, whatever level of success that is, if they're on their way up or they're already making millions. And it was with a group of people that I got to learn from myself while also being able to share lessons with those who wanted to learn some of those techniques. So that was really the driver behind why we moved to commercial, was the scalability, the ability to hire experts specifically from a management perspective. But, I think it's one of the best tools to really deliver what people really want when they think of investing in real estate. Most people don't want to operate a rental property. What they want is that freedom and flexibility. They want to go have fun. They want to know that their legacy is protected and their family's in a good spot. And I'm just grateful I was able to find that early in my career.
Yeah. Yeah. And I'm sorry I had to come out. I mean, you got clarity after a tragedy. And I think that happens with a lot of people. Tragedies in our life make us really sit down and rethink a lot of things. Sorry that you had to go through that and lose a sibling. What you made out of it is amazing. So let's talk about one of the deals that you've done. Pick your favorite. Give us an idea of the type of apartment deals that you guys get into.
What we're really focused on is, obviously we come from a background of being able to add value to properties and force appreciation. So we like to see opportunities where we can buy things that are undervalued versus where we believe we can push that value. We really believe that value is created. It's not just something that magically happens. We can obviously appreciate the appreciation that's happened in the market over the last decade, but being able to create it is something that's kind of core to our values. But one of the things that Von Finch is really good at is we're an investment manager and a sponsor. And so what we like to do, and where we think our advantages, really comes down to financial ingenuity, being able to create deal structures that put the investors in a better protected position. And so there's a couple different examples of how we've done that. But one of my favorite projects that we've worked on is a 232 unit deal out in Dallas, Texas. It's out in an area of South Dallas, maybe 10 minutes from Bishop. It's an area that is changing and gentrifying. 5 years ago, I would have never bought a property there. But 5 years from now, assuming things continue, and even in a very slow way, I'd be, very excited to own in that area because of that path of progress. One of the things I like about this property is that we're buying it from a manager who's been known to be a slumlord, really treat tenants in not the greatest way. We've been able to come in, renovate that property, add solar to that property to really be able to create an additional value on top of the value that we're already adding, just by us coming in and changing management and letting folks know there's a new sheriff in town, you're paying rent or you're leaving, and really starting to create more community at that property. We've been able to see some great changes happen. Now, as we all know, in value add, it takes some time to execute those plans, but The way this deal was structured was a 10-year hold with a 3 to 5 year finance window and a hold forever type of a mentality. So yes, it's a 10-year hold, but we really would like to hold this for the long term. But while being able to return 100% of capital to investors within that initial kind of value add period. So what's nice about that is you get that bump of the value add, you get your capital back, and then you're able to go and reinvest it into another property.
Right. And from there on out for your investors, it's infinite returns, which is nice. And that's one thing that I think is a shortfall with most syndications is their 2 to 3 year horizons, and you don't take advantage of the long-term benefits of a lot of real estate transactions. And something I'd like to point out that you said earlier, just, you talked about the forced appreciation, you talked about adding value. And, I love that aspect with real estate because you can come in and, with a little bit of money, turn it into a lot more, improve the finishes, improve the property, however it needs the improvements. And that'll add value to the property. You'll get more income from the property, correspondingly more income for your investors as well. And something else that you said that I want to highlight is value adds take time. It takes time. I spent a little bit of time on a big Navy ship, 800, 900 foot long ship. It takes a lot of time to change course. And I think a lot of these properties are just like that. The big ship example is you got a lot of momentum going one direction, and it takes a lot of time to change that direction and get it going in a different direction. So that's something that I think a lot of the newer syndicators and mostly aspiring investors, the type of people who listen to this show, don't always understand is, it's not a 4-month thing. It's not a 6-month thing. Sometimes it takes a year or two to change the culture.
It's really important to acknowledge the environment that we're in today, because for the last 3 to 5 years, investors have been fortunate enough to see massive amounts of growth within the economy. And what that's resulted in is projects that were typically 5-year projects exiting in 18 or 24 months, right? Doubling their money within that period. And that's a phenomenal place to be. Von Finch is lucky enough to have had a couple of those great exits and be able to return capital to investors. But it's important to understand where we're at today, and that's not typical for a normal investment cycle, especially in real estate, because one of the benefits of real estate is that it's a much more secure type of investment. You're investing in a real asset, and the likelihood of a total loss is very low, but the likelihood of doubling your money in 12 months is also low, right? And so what we're seeing today is that we're in this environment where interest rates are going up because the Fed is looking to reduce inflation. And so when interest rates go up, the cost of that debt goes up. And we're also seeing the reduction in the loan to values down from 75 down all the way down to about 60%, sometimes lower, sometimes higher, depending on the project. But what that does from an investment perspective is it requires more equity. When you've got higher interest payments on an annual basis and you're required more equity, the returns that are available have to be split between more investment dollars. We're in a place today where there's still phenomenal opportunities, and we're really excited about what's ahead. But the returns that were available 6 or 12 months ago, what we might have gone out to market as a 17% IRR or a 8% cash on cash return, we're seeing those same deals with today's debt would only be maybe a 4 or 5 or maybe a 6% cash flow, and as low as a 14 or a 15% IRR. So as good as some of the projects have been over the last couple of years, there's still some great opportunity coming ahead. But it's really important for investors to understand that as the market shifts, so must their expectations. Wouldn't you agree, Brian?
I absolutely agree. And I think something that's very appealing with multifamily is you're much less likely to lose. And right now, I mean, I don't think anybody can decide whether or not we're in a recession. I think we're at the tip of the iceberg right now. I think it's going to get worse before it gets better. But the stock market in the last month dropped 5% roughly. When you look at what's going to happen if things continue to get worse or the economy continues to worsen as rates go up, a lot of the other investments are going to lose value. And so not only do the investors have to change their mindset on, what the returns are on multifamily, but their overall, they have to change their overall philosophy. And one thing that real estate really does in this type of environment is preserve value. So instead of rolling the dice in the stock market, and I don't know, maybe you lose 10% in the next 12 months, maybe you gain 10%. Instead of rolling the dice with the stock market, staring down a recession, maybe you put more money into real estate right now that preserves value and will still come up with that 12 to 15%, return on investment over 4 or 5 years. That's my point. Yeah.
And that's what's ahead for us is we're really looking at what's happening in the market today. And we're saying, hey, we've closed $180 million of investment real estate. We've been able to double investors' money and be able to deliver some great returns. And we've been able to go out and buy a lot of projects. And we've been quite growth focused. But naturally, as someone who's been in the market through ups and downs of interest rates, through the COVID recession, through other changes that have happened since I've been in the game of real estate, and my mentors and advisors have to really shift our focus to allocating a good part of our portfolio towards preservation of capital. As Blackstone recently said, it's the first time in a decade that it's made sense to focus on preservation over exclusively focusing on growth. What's next for us is we're going to continue to look for great deals that are individual assets that we'll be able to exchange 1031 dollars into, bring, really great investors in who are looking for long-term holds, because we do believe there's going to be some great opportunities when we're looking at it from a long-term perspective. But simultaneously, we've also put together a great preferred equity fund where we're actually placing preferred equity with institutional style operators who we know, like, and trust, have gone through our deep due diligence process, and where we're able to create a great hedge against inflation, a 10, 11, 12% preferred return paid to investors that really sets them up to be in a position where they're not sitting on cash, because if you're sitting on cash or investing in cash, you're likely losing an 8 or 10% rate of it based on the rate of inflation today. Maybe you're giving up some of that downside because, one of the benefits of preferred equity, depending on the structure, what we're seeing is we're able to create about 75% of the return while only taking about a third of the risk. Because we've got that 20% buffer of common equity ahead of us. So our big focus right now is we still are bullish on where the market's going to go. And we believe there's great opportunities today and there will be great opportunities tomorrow. However, we are really putting a strong part of our focus into this preferred equity strategy. And, we brought on a chief investment officer in the last year, and he came from AEW Capital Management, one of the largest real estate fund managers in the world, akin to Goldman Sachs without the name. And he bringing that experience on a deal structure perspective and seeing the value of preferred equity in the institutional world, we're excited to be able to offer that to investors who are typically only able to invest in individual syndications.
Yeah, I love that. And for people who don't understand preferred equity, typically when you look at priority of payment, I mean, most people know that, the debt gets paid first. You have to pay the debt first and then the equity holders. The preferred equity slice goes between the debt and the common equity holders. And so it ends up being a safer investment. The preferred equity tranche, the preferred equity investors get their returns first, but they're typically capped. And as Steven said, 12 or 13% preferred return without the upside. So there's pros and cons to investing in preferred equity. It's more stable. And just like you said, I think you said, 75% of the returns, 1/3 of the risk, which is a pretty good place to be if that fits into your investment philosophy. That said, we need to switch gears a little bit here. So Steven, last question for you. What's next?
Well, I think as we just continue to focus on executing this strategy, we are always looking at bringing on great team members. We really believe in hiring and growing. We've started a great program for fund managers and those who are out there who are generating and have great capital partnerships to be able to bring those in and work alongside of us in the deals that we're doing. where we really see the future is we're bullish on what's ahead. We're focused on preservation in the present, and we're looking to bring both great employees and team members internally, while also going out into the market and finding great partners who are excited about what's ahead, who've cultivated great relationships, and that we can find a way to create a win-win opportunity to work with great people. Because, I really believe that life is short and we better enjoy every moment of it. So I want to work with other people who have like-minded values, who are transparent, communicate well, and who follow kind of our no jerk policy, who can be direct and forthright with what they need and want. But, we're really looking to build something great and to really make an impact for our investors and our clients in their lives.
I love it. The no jerk philosophy. Don't work with jerks. All right. Another quick shifting gears, and we're going to bring on our aspiring investor. So Scott, thanks for hanging out. Glad to finally get you on the podcast. How's it going?
It's going great. I feel like I've learned so much already just listening to Steven. So I appreciate you having me on here, Brian.
Absolutely. Absolutely. Now, as most people who are listening to you talk can tell, you're not from the US. So tell us where you're from.
So I'm out of Austin, Texas, and as if the accent doesn't give it away, I originally grew up in Scotland, so long way from home. Some days I wake up and wonder, where did my life go to end up here in Austin? But enjoy the sunshine, that's for sure.
Yeah, I hope that's a good thing most days when you wake up. But, I guess it depends on perspective. One of my neighbors is getting married later this month, and their honeymoon is going to be in Scotland. I guess you got people going the other direction as well.
Well, I hope the weather's good for them, but I hear last year summer was on a Tuesday, so they'll have to time it well.
Yeah, nice. Yeah, sometimes it's all perspective. I live in Idaho Falls, and we have a really short summer. Surprisingly, it's still in the 90s today in September, but I think the first day it hit the 80s was mid-June here. Summer here is about a 2-month phenomena. Anyway, getting used to it. Scott, tell us a little bit more about yourself.
Yeah, so my name's Scott MacDonald, originally from Scotland, as I touched upon. Here in Austin, Texas, with a wife, 2 kids, a dog, and 9 chickens. So firmly planted in Texas and enjoy it here. Kind of got started in real estate in 2016, and we bought our first duplex and kind of went from there. And so it's been quite a journey, but now trying to change that ship you talked about, that long change in direction and move into the multifamily space. So having the opportunity to learn from the likes of you and Stevens has been huge for me.
I know you started a duplex and you have a nice portfolio of properties in the Austin area. What's the biggest challenge you've had so far transitioning to multifamily?
Just the mindset, really. I feel that single family is kind of not a team sport where multi is. And so in single family, you can go to these meetups and they can preach that it's a team game and everybody likes everyone, but it feels so much more cutthroat that everybody's in it to get their own piece of the pie, where you go into the multi space and it's like, hey, we've got 10 dozen pies here. Everyone can have a bit. Come on, sit at the table. And so the multi-space just seems much more inclusive compared to the single family space there, for sure. So that's been the biggest difference in kind of understanding and adjusting there.
Talking about motivations, one question I like to ask, and just realized I missed it with Steve, and maybe we'll come back to it. Scott, what's your big burning why?
I came from a humble background, and when we started getting into real estate, we kind of made the decision, me and my wife, that we wanted to be more than just landlords. We wanted to do it with a purpose. So we kind of coined the mantra, if you will, of doing good work in a profitable way. And so as we've built the portfolio, we've been very diligent in the organizations we work with. So we go out, do a lot of Section 8 low-income housing. And we partner with some charities, some sober living facilities where we provide kind of halfway houses. We partner with the Salvation Army where we're able to provide safe houses, typically for women of domestic violence, not just providing a house, but providing that service. And so if we can be making a profit and running a business, but at the same time helping the most vulnerable in the community, that's been a big why for us and what's kept us going.
Yeah. Win-win all the way around, helping the people in the community. That's one of the great things about multifamily is, you help yourself by extra streams of income. You help your investors with the same thing, but you're also helping people in the community by making communities nicer. So very, very much appreciate that. So here comes my favorite part of the show where I say, Scott, we got Steven on the line. What do you want to ask him?
There's so many questions coming. So I was writing down a lot of questions as Stephen was talking. And I think I'm going to be quite selfish here and ask questions that I'm having a trouble with and kind of get Stephen's take. So one of the things you touched upon, Stephen, your investments seem to be all over the country. And I meet a lot of people who are investing in many states. As a single family investor, all my properties are kind of within an hour's drive for me. And so how did you make that transition? I understand there can be greener pastures in other states, but how did you make that jump into being in so many places at once, building so many teams, finding so many deals and things like that there?
Well, I would say from day one, I was pretty dead set on creating a business that would be location independent at the detriment of potential profit, even while focused on single family. I lived in California, then in Denver, and operated a house flipping operation in the triangle of Raleigh and in Minneapolis. And so there's a big downside to that. You don't have that same local network effect. You're not there. You can't just easily drive over. So you have to rely on other people. As a benefit of having to learn how to rely and hire other people, I was able to put different processes and people in place to be able to check and verify that things are happening as planned. When expanding into the commercial real estate space, it was actually a big driver, was the fact that these individual projects are large enough be able to absorb the cost of travel for me or other team members to go out to those individual assets, visually inspect them, walk them, do all the things that we need to do. One of the other benefits too, as you get into the larger space, is that you have a higher level type of professional that's typically executing the construction, the management, the third-party reports. These are organizations that specifically focus on much larger assets, and there's more profit margin for them to hire better people to be able to go out and execute and do the work. And so that's where I think the benefit of focusing on larger types of projects really is that there's more profit dollars per, dollar invested to go around to, be able to fund hiring really smart people to go out and do that work on your behalf.
And so one of the challenges in my business was finding these good contractors and these good teams. It feels even harder to do that. You talk about investing in that triangle. Like, how did you get connected to these higher caliber contractors as you touched upon there?
I think when it comes to doing stuff from a single family perspective, it really does come down to finding lead generation and then filtering. You want to get as many of those different contractors as you can. You want to bring them through a filtering process where you understand how they price. You get everyone to price the bids on the exact same way. I prefer to provide them with a scope of work, require them to provide me back with an itemized scope so I can truly compare apples to apples on an individual basis. And that's how I went about finding great people. That is also one of the challenges, is that in order to make profit in the single family space, what I found is you really did need to go towards the lower middle bottom of the pricing perspective on the type of contractors to make those kind of bids work. You can't really go towards the folks who typically deal with homeowners and maybe have a more professionally run business. So you essentially are running their business for them, keeping them in check, and you have to have good project managers in place. As you move into the commercial side, you're typically hiring third-party construction management companies that are doing this. You're maybe not getting the same value, right? It's a little bit more expensive. But in exchange, you're getting companies that are handling and hiring and doing all those pieces. It still requires construction management. However, that is where I found it to be a little bit different. Now, if you can go and take that same construction mentality from the single family space and build a great team on the commercial side, you will have an advantage and you will be able to do jobs that cheaper. When it comes to large commercial real estate, there's really, I see 3 different sections. You're either finding and closing the deal and all the things that are related to that. You're focused on operations and execution and construction management, or you're focused on capital. You have to be the best at one of those things in order to play an important role within that world. Now, you have to be good at all 3 in order to have a successful run deal. And oftentimes asset management and construction management is well overlooked in the commercial real estate space because there's been such a rising tides mentality. I think today it'll be even more important to have great asset managers and construction management teams in place, and property managers who can truly pull all the strings and twist all the dials to make sure that that asset really is run at the highest level.
And one thing I'll add, I mean, in my portfolio, the smallest is a 16 unit and the largest is 160 something. And when you look at the type of labor you can hire, the type of people you can get into it, with the 16 unit, you almost never have 2 vacant units at the same time. It's almost like you're getting a rebid every single time you do it. You have your own scope of work, but the contractor that you used last time may not be available in a timely manner this time. Whereas with the 167 unit, it's not difficult. If you're looking at a 5 to 10% vacancy, if you're at 5% vacancy, you've got 8 or 9 units open at any given point in time. And so when you bring contractors in, you're able to get the larger contractors, but they can also knock out 5 to 10 or sometimes 15 units at a time, get those up and running. And there's a lot of economies when you scale up as well with the construction. It is going to cost a little bit more. And I think Stephen hit that on the head. The larger companies have more overhead. They have better workers, higher paid workers. So dollar per dollar, it's going to cost more. But when you factor time in and everything else, it's a lot better to go with the more capable contractors.
That makes sense. I guess shifting gears a little then, one of the challenges we've had, we kind of made this decision to move from single family into multi, and we threw everything at it, and we actually purchased a 75 unit here in San Antonio. So we just completed our first raise. And one of the challenges that I found along the way was historically we'd been self-funded on all the single families. We'd never borrowed money from anyone except a bank. It was all us. And so going out and doing this raise and pitching the deal to potential investors, we got a lot of pushback from investors of saying, well, you're the guy that fixes single family homes. What are you doing in this business of 75 units? You seem to be a bit out of your depth. You talked about, Stephen, going from being that house flipper to this apartment investor. How did you communicate that message confidently?
So first, it comes down to you've got to change your own personal identity and see that you're a person who's capable of doing this, getting the knowledge, the lessons, the boots on the ground, the experience, getting those people around you who are advisors, who are going to have their hand in play as you're going out and actually doing this work is really important. I found that on the first deal that we closed on the multifamily side, I had been working with a really great friend of mine who had a very long track record of doing renovating and repositioning multifamily properties. However, he had not syndicated up until recently. And so we had been talking for years, you should syndicate, you should bring in other capital. Finally, a private equity manager taught him about this great strategy, and the aha went off. It made sense to him. His business has since 10x'd in 1 or 2 years, within 1 or 2 years of actually going out and doing this. So he saw the benefit. But as a result of that friendship and that relationship, I had an opportunity to invest and partner right alongside him. So I knew that he had the capabilities to be able to execute that strategy. I knew I had the personal relationship, and I knew his values, that if something were to go wrong, he would reimburse the project. Although there was such a huge margin that we both knew that wasn't going to be the case. And so what that allowed me to do is it allowed me to go and partner with him, leveraging his background and track record alongside my ability and my background and track record and the people who trust me to be able to go get that first deal done. It's in that process of shifting that identity from people seeing you as they see you today to seeing you as you're capable of being seen in the future. Again, I'll just reiterate, it first starts with you believing that you're capable of being this person, and 2, that you actually have this backup in place that can make sure that this project goes well and goes successfully. And then you can turn and point to that backup, to that legit advisor. Now, one thing I would recommend against is that I oftentimes will see people point to that advisor, and when I really push, because I'm the kind of person who's going to find the answer, and I encourage investors to do the same. When really pushed, I find that oftentimes that advisor doesn't actually play as significantly of a role as you might think. And so for an LP investor, it's important to really know hey, is that person making decisions day to day? Do they have money in the game? Are they taking risk with their own capital? How is that playing out? When you can get somebody whose their success is aligned with your success, you can be in a much more confident position.
Okay.
All right. We are about out of time. The last two questions are mine. And Stephen, you get to go first. How can listeners learn more about you?
I appreciate you guys taking the time to listen in. If you enjoyed today's conversation, I encourage you right now to just search on your podcasting app for Investor Mindset Show, real estate radio show. You can check out the Investor Mindset on YouTube or wherever your favorite channel is. Or if you're interested in getting invested in the same deals that I personally invest my capital in, whether those be single asset, whether that be the preferred equity fund or any other type of investment opportunity we have, I encourage you to join the Von Finch Private Investor Network. You can go to vonfinch.com/invest. That's vonfinch.com/invest. You can find me on all the social media channels like Instagram and LinkedIn, and I'd love to build a relationship with you guys.
All right, awesome. And we'll put links to the podcast and social media handles in the show notes for anybody interested. And Scott, same question for you. How can listeners learn more about you?
Yeah, absolutely. So if they head to copperdogproperties.com, that'll have a link there to sign up to our newsletter. You can find our Facebook and Instagram links and things like that there. So most active on Facebook, and love to interact with everyone there.
All right, sounds good. Well, thank you very much, gentlemen, for coming on the show today. Appreciate your guys' time and hope to talk to you soon. Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.